Every single day, billions of dollars move across financial markets in milliseconds. While most investors sit glued to their screens watching stock tickers, the world's most elite hedge funds have quietly moved beyond human emotion and intuition. They've handed the keys to artificial intelligence. The algorithms making trades right now are not second-guessing themselves. They don't panic when markets crash. They don't celebrate when stocks soar. And most importantly, they're consistently generating returns that seem almost impossible. But what if the secret sauce isn't magic at all? What if it's just mathematics meeting machine learning in ways most traders have never imagined? How hedge funds weaponize data. The first thing separating the elite hedge funds from everyone else isn't luck or guesswork. It's data. Not just any data, but the kind that reveals patterns invisible to the human eye. While average investors analyze quarterly earnings reports and read financial news articles, cutting-edge hedge funds are consuming petabytes of information daily. They're analyzing everything from weather patterns to web traffic, from satellite images showing parking lot congestion to credit card transactions revealing consumer behavior. Alternative data has become the competitive weapon of the sophisticated investor. This includes information that traditional financial analysis completely ignores, yet which contains surprisingly powerful predictive signals about future market movements. Ray Dalio's Bridgewater Associates, one of the world's largest hedge funds managing over $130 billion, has been pioneering this approach for decades. Dalio famously translated his investment philosophy into mathematical equations, essentially creating an artificial intelligence version of his own decision-making process. The system doesn't predict where markets will go. Instead, it continuously reacts to real-time market information using tens of millions of discrete datasets filtered through sophisticated economic machines. These machines detect shifting fundamentals through real-time indicators and then validate price movements using trend filters based on past outcomes. The result, a consistently disciplined approach that removes emotional bias from trading entirely. Dalio has since created Digital Ray, an AI clone trained on 50 years of his research, notes, and trading data. This digital version performs at 95% effectiveness of Dalio himself, allowing the fund to scale his wisdom across thousands of simultaneous decisions. But Bridgewater isn't alone. Renaissance Technologies, founded by legendary mathematician Jim Simons, achieved something that still stuns the financial world. The firm's medallion fund generated an average annual return of 66% before fees for 3 consecutive decades. To put that in perspective, Warren Buffett's legendary returns hovered around 20% annually. During the 2008 financial crisis, when most funds collapsed, Medallion delivered a 74.6% return. In 2020, during extreme market volatility, it achieved a 149% gross return. These numbers seem almost impossible until you understand the methodology behind them. The secret wasn't stock-picking talent or market timing intuition. It was machine learning. Simons, a code breaker who worked for the government during the Cold War, built a system that identified non-random patterns in market price movements. He believed that while markets appear random, statistical patterns exist that can be exploited. He recruited the world's most brilliant mathematicians and physicists, not Wall Street veterans. These scientists developed algorithms that executed between 150,000 and 300,000 trades daily, all automatically. The firm had a strict rule: never override the computer. Decisions remained purely data-driven, completely free from human interference. Simons famously said he doesn't need to understand why something happens in the market. He only needs to identify reliable patterns and trade them systematically. This philosophy transformed quantitative investing forever. Strategies and systems. Today's hedge funds employ a sophisticated arsenal of AI technologies that most people don't even know exist. Machine learning algorithms scan vast data sets, looking for correlations that predict price movements with surprising accuracy. Natural language processing systems analyze thousands of earnings calls, news articles, and policy announcements in seconds, converting qualitative market sentiment into quantitative trading signals that can drive trading decisions. Deep learning models identify subtle, non-linear patterns in asset behavior that would be impossible for traditional statistical methods to uncover, allowing algorithms to continuously adapt to changing market conditions. One particularly powerful technique is statistical arbitrage. AI systems identify tiny price discrepancies between related securities that humans would never notice. While individual profits from each trade might be microscopic, executing millions of these trades daily compounds those gains into extraordinary returns. A single basis point of profit multiplied by millions of transactions becomes enormous wealth. These algorithms work at speeds humans simply cannot match. Where a human trader might analyze a single stock for minutes or hours, AI systems evaluate entire markets in milliseconds, simultaneously processing billions of data points. Generative AI represents the newest frontier in this evolution. These advanced models can analyze macroeconomic datasets and earnings calls to surface patterns too labor-intensive for human analysts to catch manually. They test trading strategies against hypothetical but plausible alternative market scenarios before deploying real capital. Quantitative funds are now using generative adversarial networks to simulate synthetic financial time series, testing their models against conditions that have never occurred in history to ensure robustness. Risk management has been transformed entirely. Rather than waiting for risks to materialize, AI systems now monitor portfolios in real time, automatically adjusting positions based on changing market conditions and risk exposure. Some funds use AI to monitor internal communications, automatically flagging unusual trading patterns or compliance violations that human compliance officers might miss. Man Group, one of the world's largest hedge funds, uses artificial intelligence to dynamically adjust portfolio weights based on macro signals and risk factors in real time, sometimes adjusting positions hundreds of times per day. Bridgewater is experimenting with AI pilots that cut manual review time for compliance by 70%. Why AI trading works, the evidence supporting AI-driven trading strategies isn't theoretical anymore. It's empirical and undeniable. In recent studies comparing AI-generated trading decisions against human expert traders, AI models outperformed humans in average returns and risk-reward potential. The data showed AI systems generated more consistent returns over time and operated at speeds impossible for human execution. While humans excelled at qualitative judgment and understanding nuanced market dynamics, AI dominated pure numerical prediction and execution speed. Between May 2017 and May 2020, AI-led hedge funds produced cumulative returns of 34%. During the same period, the global hedge fund industry averaged only 12%. That's nearly 3 times better performance. Industry surveys now show that 56% of hedge funds have adopted machine learning in their trading processes, and this adoption is accelerating at an exponential pace. Newer entrants to the field understand that competing without AI is nearly impossible in modern markets. The beauty of this approach becomes obvious during market crises. Traditional models failed catastrophically during the 2020 pandemic crash because they relied on historical linear relationships that suddenly became obsolete. AI systems, however, don't assume anything about market structure. They simply model what the data shows. When anomalies appear, they raise alarm signals. Early in February 2020, one firm's anomaly detection system identified that oil markets were behaving in unprecedented ways, reaching 100% anomaly scores weeks before the massive crash that followed. This early warning gave the fund time to reposition and protect capital while competitors were blindsided. Advanced machine learning handles complexity that traditional analysis cannot process. These systems identify hidden correlations among thousands of variables simultaneously, detecting relationships that would take human analysts months to uncover. They detect style drift in fund strategies and identify factor exposures invisible to conventional analysis. They optimize position sizing based on real-time market conditions, automatically concentrating capital where the edge is strongest and reducing exposure where conditions are weakest. The competitive advantage is becoming difficult to ignore. Hedge funds using AI gain the ability to make informed decisions faster than competitors. They optimize trading strategies more effectively. They manage risks more intelligently. This enables them to act swiftly and pivot confidently when market conditions shift unexpectedly. It's not just about making better trades. It's about making decisions at machine speed while competitors are still processing information. The funds that mastered this transition early now oversee some of the largest concentrations of capital globally. As the financial world evolves, one principle becomes clearer each year. The days of purely human decision-making in professional investing are ending. This doesn't mean human judgment disappears entirely. The most successful funds blend artificial intelligence with human oversight, creating hybrid systems where machines handle the quantitative complexity while humans provide strategic direction and ethical guidance. This partnership model is proving far superior to purely automated systems. The hedge funds that recognize this transition early now manage some of the largest pools of capital on the planet. Those that ignored it have watched competitors eat their lunch. For retail investors watching from the sidelines, the message is equally clear. The investment landscape has fundamentally transformed. The players who understand artificial intelligence and adapt to it will thrive in the next decade. Those who cling to outdated methodologies will simply fall further behind.